A December rate cut is not, quote, a foregone conclusion, unquote, according to JPow. We're going to talk a little bit about that and take your questions today on Open Interest. Wondering why, after all of the rosy prognostications that the market has been seeing of late, that suddenly the futures sold off this afternoon, a little after 2 o'clock. I have that chart up right here. And the reason was because of Fed Chairman Jay Powell's comments. He came out and said that a Fed rate cut is not a foregone conclusion. In response to this, short-term rates took a pretty pronounced pop. Actually, when I was looking at this earlier, they were up almost 12 basis points. Let's see where they are as of right now. 11 basis points. So it got a good move off basically those remarks. It seems like that was, didn't get people too concerned. He was making some other comments. I don't know if anybody else happened to be listening to it, but one of the things he said was with respect to the labor market, that they weren't seeing signs, in his view, that there was considerable weakening. I don't remember the exact terms he was using, but when asked about the layoffs, and there have been some notable sort of, one of the things that will often happen is you've got journalists who are in the room, you have the Bureau of Labor and Statistics numbers that will come out periodically, but you also get headline events that get people wondering whether this is what's going on. So what are some of the headline events? We had UPS announcing 34,000 layoffs. We had Amazon announcing 14,000 layoffs. I think it was either intraday or late today that we got the announcement that Target was going to lay off 1,000 people and also was not going to ultimately end up filling 800 unfilled positions as they do a little bit of adjustments. That represents about 8% of their workforce. So I think all of those things weighed on the markets a little bit. This, of course, is combined with, what was actually decent. I mean, not great, but decent, maybe better than expected inflation data that we got last week. So I think that's one of the reasons why we haven't actually been more punished. I kind of would have expected that 20 handles in the S&P, which is all we're down, at least according to where the futures are ticking right now. And actually what's going to be impacting it right now is not so much the futures, but actually what's happening on the earnings front. And we have some big ones, so we should probably take a quick peek at that. I'm going to just put that on a separate screen here, so we have it at the ready, so we can just sort of see where these numbers are coming in today that are being announced, because this is a big earnings week, as you might expect. So what do we have here? I need to just sort these things by ticker. By the way, in case anybody happened to see this, Caterpillar got a big bounce today. And one of the things I thought was kind of amusing, one of the reasons for this was because of AI. And the bullish case is that they're going to be building so many data centers. That's a positive for construction. And I thought that's kind of interesting, that just like back in the tech bubble days, they would add .com to any business, and of course this is the same kind of story here, where everybody just adds AI to the story. And I couldn't believe that actually happened with Caterpillar. Let me show you what I mean. I thought this is kind of interesting right here. Caterpillar soars as data centers lift their power equipment sales. Cat says AI power drives growth more than bulldozers. So that I thought was kind of interesting. So things to think about. All right, so let me just move on really quickly to one of the questions that we got straight away, which was on United Health. And I was just in the process before we went live of taking a look and seeing when I last spoke about this. So I think it was Jim Howard's question. Let me just bring it up. Here we are. There we are. Okay. So it's interesting. I wrote an article about United Health, which I believe got published on the Options Edge and also on the CNBC Pro website. And I found when I sent the article in, I believe it got published on May 15th. I believe I sent it on May 14th in the evening. And then I happened to be looking at the Options Edge, and I saw that Mark Guthner, I had proposed a call spread risk reversal in May. And then I saw that Mark Guthner actually had proposed a bullish bet with quite a lot of detail. He was selling a put spread on United Health. This one was dated to June 16th. And producer Jay also was taking a look. And apparently we discussed it on one of the live streams in mid-August as well, talking about United Health, a name that's come up on more than one occasion. So let's just take a quick peek at the chart here. It does feel to me like the worst of the damage is over. So back here on the 15th is when I published an article on it, bullish trade. The 16th is when Mark Guthner published one on the Options Edge website. And then we discussed it again in August. And really, throughout that period, it was unchanged to actually a little bit lower. So I thought I might have almost bottom ticked it in May, which would have just been luck, by the way. I never bottom tick anything. But in fact, I did not, because the stock did trade lower in early August. I think it was right in here, possibly off this gap, that we brought it up on the live stream here, and obviously the stock's up a decent bit since then, about $55. We'll say it was worth, we'll say it's up $50 off of 300 at the time. What's my thinking on United Health here? Well, a couple things. First of all, they're not going to be announcing earnings again until January. My second thing that I would point out is that implied volatility is still relatively high, given where I expect implied vol will be between now and when they report next. So the orange line that we're looking at here, which I'm going to highlight, that line is 1 month implied, 2 months implied, which also do not capture the next earnings. In the mid 30s, and this is 30-day trailing realized volatility. And of course, you see a bump here because the stock gapped. That was that gap that I was showing you before. Let me just put the price in so we can see that. Right after their earnings announcement. Go. There we are. So in August, we got this pop. That's that sudden uptick in volatility. So the orange line jumped here, corresponding to the price jump in the stock, which was a fairly pronounced move. But since that time, it's been much steadier. So I think that this is still a name that one can, the real concern, I remember when they first started to announce they had a lot of bad things coming out all at once. Obviously, we had that horrific shooting that took place in Manhattan. And then following on that were the investigations. And that's always, that's the kind of thing that you're always a little bit concerned about the next shoe to drop. But on a valuation basis, the company is certainly cheap relative to where it's been historically. They brought old management back, which should solve some of those problems. And, you put those things together, and I think it's, a potential place to think about. One other thing I actually wanted to point out. I had been talking about Berkshire Hathaway. In fact, I mentioned it on Power Lunch yesterday. And, I'm kind of two minds about this, because one of the things that a former colleague and I spoke about earlier today is just that, the insurance businesses in general they're out of favor, plain and simple. So whether, we're talking in this case about health insurers, its comp group here only showing Elevance and Cigna, but other names you would consider in the same group would include names like Humana. But it's not just these. P&C insurance also not trading at terrific multiples. Let's take a look at Progressive. That's tipper PGR. And so a lot of people who are naysayers on Berkshire, because that's a big part of their business, this is what they're talking about. So the blue dots represent where the valuation is now relative to its 2-year historical range. And you can see it's at the bottom, right? Let's look at a 5-year range and see how close we are. Let's wait. At the bottom in terms of price to book, not far off the bottom in terms of price to forward earnings estimates. And, somebody was, this colleague of mine who, he is a deep dive fundamental investor, but he does pay a decent amount of time looking at technicals. His logic on this is he just doesn't stay in trades that aren't working. So he gets into something. If it's working, he sticks with it. If it's not working, he just blows out of it. So I'll come back to it when it starts to work. So he tends to be a little bit nimble. He and I were kind of at odds on this. Maybe I'm taking a slightly longer view. I don't think that just because a group is trading at low multiples that therefore I'm not interested. That, in a longer sense, that can actually provide an opportunity. This one actually is a better representation because we can see a lot of other names in here. And Berkshire, don't forget that there's more going on here than just in insurance. But my thinking is that these businesses are likely going to come to life, and one of the things that could bring them to life is a flight to value stocks potentially. So I'm in favor of it, and I still think that if you're in United Health, you can stick with it. It does seem like the worst, at least from a technical point of view right now, the worst is behind it. We don't have any news coming out for the next 60 days. And Vol's expensive, so the trade I had recommended, I don't know if I did that same trade on this live stream, but the one that I put in the article was a call spread risk reversal. Again, trying to sell more options than you're buying. I think that's an okay trade here. What one might I look at? So we would just take a look at, and we're going to put in a short put, so a call spread risk reversal. Let's go down into this neighborhood here. Maybe sell the 330s. Something like this, I think would be fine. You can see that you're not really laying out as a function of the stock's own price. It's a relatively small amount of premium. Move the strikes around as you see fit. That would be certainly a possibility. I also will say that I don't mind the idea of potentially a strangle sale in this one, because again, there's not a huge amount of news that I would anticipate in the near term. The only thing that I would say as a potential caution on this is that what would cause the stock to rocket higher here? Given the pressure that we've seen just on the multiples in the space generally, the fact that there is no news, the one bit of naked upside exposure that might be a bit discomforting is that, if you got someone coming out and saying, we investigated, we were looking at the Medicaid claims issue, and, we're going to take no action. Found no wrongdoing, and we're taking no action. Something like that comes out, then I think the stock could really make a move sharply higher. But absent that, I think selling a strangle is probably not a bad play here. I would lean long deltas if I was going to do a trade like that. So something a bit like this trade right here, where you're short a closer to at-the-money put strike and a farther out-of-the-money call strike, just reflecting a slightly bullish bias. I don't know how much of an impact the government shutdown is going to have on things like this. I can tell you we have some interaction with government agencies as a function of our work. So, we launch funds. We are bringing securities, starting trading on securities pretty regularly. And the SEC has to do reviews for these things. And there's some give and take that often happens, so some Q&A periods. The SEC is operating on what we might call a skeleton crew. I'm sure that this is probably true for some other agencies as well. I laud them on the efforts of those that are coming into the office and doing their work for what they are getting accomplished, because it seems like they're doing a decent job. But we shouldn't kid ourselves. Things have slowed down at government agencies. It is not just that we're not getting updated economic releases. There's other things that are going on. So investigation here is, is there likely to be an announcement? I think it actually reduces the likelihood that there would be an announcement sooner. My 2 cents. So just something to think about there. All right. So let's move on. Okay. So, do you see any trade on one of the Mag 7 names? Google, MS, I'm assuming you mean MSFT, Microsoft, Meta, after earnings today, or wait for Apple's report tomorrow? So, I would say I don't... it's funny, because when I was on yesterday on Power Lunch, I was asked what I thought, not of these names. They did ask me about Apple, but Brian Sullivan said to me, he said, do you think Nvidia is expensive? And I said, no, I don't think Nvidia is expensive, because as all will know, I like to compare the value of companies relative to the broad market. This is a company that's expected to do $6.50-ish of adjusted EPS next year. That's 45% year-on-year growth, and that puts us at, and I'm going to use 6.5, 31 times earnings with 45% growth. That's not expensive. And now there's the question of sustainability. I get all that, but only once and if we start to see the hyperscalers suggest that they're going to start cutting back on their investments might we get concerned. Look at Amazon when they announced those layoffs. One of the things that they talked about was their infrastructure spend and how they expected to have more CapEx for things like AI. So that doesn't seem to be slowing down. Apple's report tomorrow, I view that as a little bit more divorced from that broader trade. I think the Apple results are going to talk about sales on these things, the iPhone 17s. Got 2 of them on my desk right now. I'm not sure why. I ordered one. I had a problem with it. I returned it, asked for a replacement. They said it was back ordered, and then a day or two later I got one, and then I got another one. So I think one of these is supposed to go back. I'm not exactly sure. But the fact that it was back ordered was supposedly back ordered was a positive sign. And it does seem like the initial sales are suggesting that this is one of the faster sort of refresh product cycles that they've had. In other words, that the uptake on the iPhone 17 appears to be a little bit better than it has been for some of the prior phones. So that's certainly a positive. And the other thing that I think is a positive for Apple, which I may have mentioned in an earlier show, I'm pretty sure I did, is that the top line is actually picking up here. I was not hugely enamored of the company when I saw things slowing down, and I was a little bit concerned about their sales in places like China, which is a real growth opportunity. I mean, they've got pretty much... could they grab more market share in the United States than they already have? I suppose. They already are the dominant player, though. So I don't give them I wouldn't give them a premium on the expectation that they grab market share here, because I feel like there's also the risk that they lose it. So that's not a real positive. But uptake in other markets, and China in particular, is important. And we are getting some top-line revenue improvement. Here, though, what are we looking at? So let's take a look first at what the expectation is for the numbers they're about to report. So we're looking at $1.77, which is 8% year-on-year growth. And then looking out to next year, the expectation is, just over 9% growth, which is respectable, right? I mean, really exciting? No, but it's respectable. The issue that I have is that puts us at almost 34 times forward. And 34 times forward at a market-esque growth rate just doesn't excite me. And that's kind of what I said when I was on Power Lunch, and that's just my view. Great business, great products, great free cash flow. If you own it, this isn't a race out to sell it kind of a thing. By the way, if you have a really low basis, somebody pinged me yesterday and said, "Oh, should I sell my Apple shares?" And then mentioned that they have a basis of $23. Well, and this person happens to live in California. They live down in Los Gatos or something. And what does that mean? So if you have a 23 basis, that means that you're looking at $245 of appreciation in the shares in a state that taxes capital gains like income. So you're looking at 40% of the difference out the door. That's 40% of $240. And the question then becomes, well, maybe I'm not enamored of the stock at 33 times, but if he's going to pay taxes on this thing in the neighborhood of $98 a share, we'll just round that. We'll round it up. We'll call it 100, right? So that's $170. So the question is, if you're one of these people, am I encouraging you to sell it if you are in that circumstance? No, because then now you're selling it at 21 times earnings. Because that's effectively what you're going to realize net of taxes for selling the stock. And that's one of the reasons, you might feel from time to time when people talk about stocks that they're waffling, buy, sell, or hold. But in this case, it's a hold, because I wouldn't tell anybody to short the stock at 21 times forward earnings. So if you have a really low basis in the stock, I guess you're kind of stuck there. Now, if you have it in a tax-deferred account or a tax-exempt account, or your basis is not anywhere near that, so you don't really have a big tax consequence, or you have realized losses to take up the slack on those gains. Do I like it at 32 times forward earnings here? Not so much. Right? So Tucker D Dog adds to this and says, I feel like Apple keeps missing the ball with AI or dropping it. Supposedly they started shipping AI servers, but I don't know who's buying them. This is an interesting thing. Apple is not the same kind of an AI story that all of these other companies are. Meta, Microsoft, Alphabet, actually Amazon. I think all of them are in this space. Clearly Nvidia too. I don't feel like you need to wait for Apple earnings to make a determination on any of these other stocks. I don't see those. I'm going to put Apple into its own bucket. I think we've now done that, and we can move on. Let's talk a little bit about Alphabet. Alphabet, again, for those of you who are following the channel and have been following it all year, you will know that in my double G rising acronym, best ideas for 2025, one of the two G's was for Alphabet, for Google. The other was for Gold. That didn't work so great straight out of the gates. In fact, actually, it was grossly underperforming the market. Hey, Mike, the options play affiliate link doesn't seem to be working. Thank you for bringing that to my attention. We will investigate that. So we'll definitely need to make a note of that. Okay, so let's just talk about Alphabet first. I liked Alphabet at the beginning of the year. I still do. It's not unreasonably priced. We can see right here, take a look at this thing. Right, so we were just talking about, again, we'll just use round numbers. This thing's trading less than a market multiple of forward with better growth. So Apple's trading at a premium with equal growth. This one's trading at a discount with better growth. So plain and simple, I liked it, and I still do. All the other stuff applies. Microsoft, which is, I assume what you're talking about, you put MS, which is actually Morgan Stanley, but I'm assuming what you meant because you said Mag 7 is Microsoft. Microsoft's valuation's a little interesting to me. I have often felt like it trades just a bit rich for my blood on that score, but it is hard to argue with the fundamentals. We're going to get almost $100 billion in free cash flow out of this thing next year. It's growing much faster, growing earnings much faster than the S&P generally, and we're trading at 29.5, so 2 turns richer than the S&P with 30-40% faster adjusted EPS growth, massive free cash flow. So yeah, still like Microsoft. Again, it's not as cheap to me as Alphabet is. Bear in mind that one of the reasons Alphabet had that big discount, and the reason we got that, underperformance followed by outperformance, which it has done since it came off the bottom. The reason for that, most of you already know this, I'll just mention it anyway. There was a government cloud. Were they going to be forced to divest Chrome? That was one of the concerns. Government said no, and that basically sort of freed up this most recent leg higher. But still, even net of its increase, it's very reasonably priced. Okay, so let's take a look at Meta. 16% top line growth. Adjusted EPS is forecast effectively right now that they're not actually going to have incremental growth. I'm going to use a $35 a share number, but this thing is also trading cheaper than the S&P. So I like this one too still, I guess. I don't see a problem with this either. Simple as that. We like to see companies that are growing at a good rate, that are trading at a reasonable turn to forward earnings, and where we don't see some cliff that's going to, handicap it. I think one of the knocks on Meta in the past, a deserved one, it should be said, was that because of the share class arrangement and the fact that, the company is going to march to the beat of Mark Zuckerberg's drum. He has full control of the company by virtue of his control of the voting rights. And, he has made some strategic missteps. He did that with his big spend in the metaverse. But I don't think that they are making that mistake now. Seems like they've pivoted. He's a smart guy. And I will also say, in my experience, a lot of these companies, they just do better with the founders at the helm. I got into it a little bit with Kara Swisher on this many, many years ago. We were all at the San Francisco bureau, and she was on the desk. And I think this is when Jack was coming back to Twitter. Oh, my God, how long ago was that? I mean, it was probably 10 years ago or whatever. And I made a comment that I thought that a lot of these companies did better with the founders at the helm. And, she said, basically dismissed that out of hand. So first of all, that's just full disclosure that, not everybody agrees with me, and sometimes prominent people do not. But we certainly disagree on this, and I continue to. One of the things that I have said on this channel and every chance I get, I don't like it when simple's not fair, business people take over innovative companies. And I don't like it when they take over companies that depend a lot on engineering. I think this is the kind of mistake that was made at Intel on more than one occasion. I think that if you are in the technology space, you need a technologist at the helm, because their growth rates tend to be because they have people who are not trying to optimize an operating business, but who are trying to innovate and grow what they still view as a new business. And so on balance, the control that Zuckerberg has, in Meta's case, I remain in favor of it until, someone can really convince me that he's gone off the reservation. I don't see any evidence of that. So let's just take a look at it from an options perspective real quick. What are we looking for? We're looking to see whether the implied volatility... Oh, yeah, so this is a good point because this news came out and I didn't even mention it. Thank you for bringing it up. Yohasakura says, hey, Mike, what's your opinion on Nokia's partnership with Nvidia? Seems like a short-term gain in Nokia with regression back to the mean. Covered calls look decent. Yeah, so that's $1 billion that they're going to invest. Let's look at this really quickly. Then we're going to get back to the volatility and the trades in this other one. I kind of like this. I also would say this is a situation that might set up, and I'm going to give Carter credit for this because this is where he really likes to do things like sell strangles. When you get a gap, so you get a price gap on new news and a vol spike. And this is a case where you kind of get all of these. Now, there was a super sharp pop at first in vol as well as price. It's given a little bit of both back. But vol is still highly elevated. I realize it's hard to see on this, so let me just do this. There we go. So volatility is a mean reverting process. You can buy it or sell it. Where is it right now? We're going to draw a line. It's here. Do you want to buy that line or do you want to sell that line? To me, I'm a seller. We just had a catalyst. So, what's the next catalyst to drive the stock a whole lot higher? And it had, to your point, this sharp move and then gave a little bit of it back. I kind of think we're going to find a range in here for this reset. And this is not a low volatility, by the way. We're talking about 70 vol. The problem that we have in this thing, and this is one of the reasons I don't like really low price stocks, is that when you have a low price stock, you just don't get that much flexibility with respect to the strikes in moneyness terms. So, if you have a $700 stock instead of a $7 stock, you might have $10 strikes. A $10 strike difference on a $700 stock is, de minimis, right? It's what are you dealing with, like small percentages of the current stock price. Whereas when you're dealing with something that's $7, as this is, you can take a look at the strikes. Oops, I'm saying the price, but I'm actually not on the right stock. So here's the Nokia ADRs. So you take a look at your strike selection opportunities. You have to really watch your bid-ask spreads on these types of things as well. And what strikes do we have? We have dollar strikes. Right? So you could say, I want to sell an $8 call. I want to sell a $6 put. Those are a pretty good distance apart. Or maybe a 7. Something like that. You really kind of want to... Where are the 6s? What do we got here? Is that all those are bringing in? I mean... That's the other thing, is that when you're dealing with prices this low, psychologically, it seems like 11 cents, 53 cents, at 64 cents. I mean, 64 cents on a $7.33 stock. It's 8.7% of the current underlying in the value of that strangle. Now, if you were paying commissions and you were worried about bid-ask spreads, the real reason to watch your limits in something like this, again, if those options are a nickel wide, 7 cents is 1% of the current stock price. So you got to keep an eye on that. But, something like that might be interesting because the news is out. I'm kind of with you. I think that we're going to reset at a new level. Is this a huge game changer? I don't think so. So I like that idea. I think you're onto something. Okay, so just getting right back really quickly. And actually, you know what? Let's just see what's going on with the earnings here. Did we get them yet? Everything should be out today. Microsoft, 372 a share. 367.6. 3.676 was the consensus. So mild beat. Meta 725. I've got a little. Oh, that's the gap numbers. Okay, 7.25 is the gap number versus 674. That actually looks like, what's the stock doing after hours? That's a pretty good beat, actually. Let's see here. And the stock's lower. And here's why. So the stock's lower because everyone's freaking out about CapEx. So this goes exactly to the conversation we were just having. Do you think this is a wise move or not? By the way, he came out at almost every opportunity and said, we are going to spend. We are going to spend in a big way. He believes it's existential. And what is the new CapEx number that they're expecting? 51.25 billion in revs for the quarter. That's 26% year-on-year growth on a constant currency basis. That is solid. Our current expectation, this is a direct quote, our current expectation is that capital expenditure dollar growth will be notably larger in 26 than in 2025. We also anticipate total expenses will grow at a significantly faster percentage rate in 2026 than 2025, with growth driven primarily by infrastructure costs, including incremental cloud expenses and depreciation. All right, so do you want them to invest in this space or not? I think the answer to that very simply is yes. So they had very good top-line growth. They beat consensus in terms of adjusted EPS, and they announced that the big investments that they're going to make next year are going to be even bigger than previously said. By the way, what does that do for Nvidia, right? When the big spenders are saying, we said we were going to spend way more than we've been spending, and we're going to spend way more than we said the way more was. All right. So where does that leave us? I think, and look at this thing, actually. I mean, it really hasn't made that much progress. We've got a little bit of a reset down here. What did I say it was trading at? I mean, you could conceivably give it a few days to play out if you're really concerned. You want to adhere to the 3-day rule. It's down 7%, but we'll just call it $700. Unfortunately, when I model this out in here, it's not going to look great because it's going to reflect the closing prices. But I'm going to actually build out the trade the way I think one might want to play this. And, your mileage may vary a little bit. Could we run into some resistance? In here, I think that's possible. But let's just take a peek. So let's say that it's 700. If it opens here, round numbers, why not? Give that thing at least 10% to the upside if you're going to go out this far. And the thing is that because it's a pullback, there may be an opportunity off the open tomorrow to get some decent premium out of this. So I would like to sell some premium in it if it's still bid. This is a little bit, this is guidance. It's not a specific trade recommendation because you're going to have a lot could change. I mean, people are still digesting this. The stock's still moving around, so it'll be interesting to see where it goes. But I don't think that this is a time to be dumping this thing. Like I said, it's cheaper than the market, and it's growing the top line much faster. And these investment decisions are things that they can change to a degree, and they have done in the past. So there's a big difference when you're looking at the operating results of a business when you have something systemic going on that is impactful, that is beyond the company's control, versus those things that they proactively elect to do because they think it's good for their business. This is an example of the latter, not the former. I also think, though, that it could, because it causes angst. This is another situation where if there's a bid for vol, if you have the stock, you could probably sell some calls against it, maybe even sell some strangles against it, look to scale in at a lower level. But a call spread risky if you have no position seems fine. I'd lean long. And so we like Microsoft, we like Meta, and we like Alphabet. And I'm lukewarm on Apple. And I also don't think that Apple earnings matter that much for these other names. Nokia, I think it's made its move. Very high vol, premium sale opportunity there. But you've really got to watch your limits because it's a low dollar stock, and that's just something to pay attention to. Okay. So, here we have. So, Yohasakura, apparently they put a hyphen into the URL now, is what I'm being told. So the link is optionsplay.com/open-mic. So, affiliate link for OptionsPlay, optionsplay.com/open-mic. This is what I'm being told. Anil says, thank you for your comments. I'll take a look at some positions in Nvidia through options. Yeah. Ray Dalio came out. I guess he's kind of been beating the drum on this a little bit, talking about valuation. Let me see if I can find this chart. I think it's kind of informative. I had it earlier. This is the JP Morgan chart. We talked about it briefly on office hours. Not this week, I don't think. Here it is. Let's bring that up. Okay. That's not the best chart. Sorry, because it doesn't show where we are. This is, well, first of all, let's talk about what this chart is. What is this a chart of? This is a chart of annual returns for the S&P based on where you are on a price to earnings basis now. So what do we get out of this? When the S&P's trailing price to earnings is very low, the total returns for the S&P over the next decade are exceptionally high, annualized. I mean, look at this. If you're able to pick the S&P up over here, which is 13 times trailing. I don't know. I don't get to pick the S&P up at 13 times trailing earnings too often. But if you did, the annualized returns over the course of the next decade, are in this room no worse than 10%. No worse than 10%. Averaging about 15% and as high as 17.5%. Annualized for a decade. Okay? That's, blow your socks off kind of returns over a decade if you can accomplish that. What this also tells us, though, is that your annualized total rates of return are not great if you buy it when the multiple to earnings is very high. What's very high? Well, in this case, we could say high is going to be established by, and I'll show you this chart. High is going to be established by what the data suggests your performance is going to look like. Can I blow this up a little bit? Yes. Okay, so here we have another chart. These were done by JP Morgan. Same pattern, but we've introduced something. This green vertical bar is the current multiple of the S&P. That's not trailing. That must be forward. Let's see here. Oh, it is. Okay, yep. Makes sense. So this is the difference between this and that prior chart is that this one is on a forward-looking basis. And I saw that number below 23. We're not trading below 23 times trailing earnings. We are trading below 23 times forward earnings according to this chart, which I also don't buy because my own math actually shows it closer to 25. So where is 25? Let's use my nifty annotation tool. I've got to remember to. We're in here, folks. And so, at least according to JP Morgan's data, your 10-year returns are not so great. Well, if that's true, why is it then that I'm not beating the drum saying, the sky is falling? Well, part of that is because of this chart here. And it's much less conclusive. That is what the 1-year returns are, right? So is this the best valuation that you can find with a 10-year horizon? Well, the data suggests that no. Is it bad in terms of the 1-year horizon? Well, that's a lot less conclusive. The average of these numbers is positive, and we haven't seen real meaningful cracks. Are we in the later innings of a historic bull market? Yes. I think we are in the later innings, but there could be a lot of game between the 7th inning stretch and the end. And it would have been bad for people in October of '98 to say, okay, I don't want to be long equities anymore. And I don't even think it's completely comparable. I was asked about this also yesterday. Somebody said, talking about valuations, and Ray Dalio's all bearish. And I'm sure he's probably looking at these same kinds of charts. But, we aren't seeing any meaningful cracks except for one. And the crack that I'm concerned about, which I referenced on Office Hours yesterday, by the way, is, what's going on in credit, private credit. So levered loans, private credit, how does that look? Because a lot of equity market pullbacks will begin to emerge after you get a credit problem sort of coming out. And, we are seeing some. But in the big space, 34% of S&P earnings are coming, I think, or 34% of the valuation is coming from, the Mag 7 names, plus another name here or there. So this is really the story, and that story hasn't weakened. And I don't think this news coming out of Meta today that, we're going to spend as much or more as we had previously said we would, that's not the same kind of bad news, right? That's up to them. That's a business determination. Yo Hasakur is also saying, already have some Nvidia shares, but it looks like Nvidia should be a good ride for the foreseeable future. This is an interesting thing. I mentioned this actually on a call earlier today. And that is that if you sell weekly covered calls, you buy a stock and you sell weekly covered calls, you're hoping to generate some premium from those option sales, but you're capping your upside gains. I would actually just take a look at this, because I'm going to do two things here. So NVDY, which is one of the single stock covered call ETFs, I'm going to sort this by ticker here so we can take a look. This is not just selling covered calls. So let's just take a look at what we have here. It is selling call spreads. First things first. The proxy that I've often talked about, right? So it's got two sets of synthetics. Those are what we call the combos. So short the 165 puts, long the 165 calls. You can see the 165 puts down here. They're not neatly lined up on the security basis because these are flexes, cash settled, European style. So that's long, 5.4 million shares synthetically, at a 165 strike. Not sure exactly where the stock was when that was put on. We could go back and figure it out if we wanted to. There is another one at 170. So that's what these calls are over here, the 165s and 170s. Effectively, we are long 9.9 million shares of NVIDIA synthetically. Again, round numbers. And then that's supported by a couple billion in cash. The overriding strategy that we're running in here is actually short call spreads. What are those call spreads from last week to this? It was these right here. So we were short the weekly 187.5, 195, $7.50 call spread. Now the stock's trading 200. Where did it close today? 207. Okay. So why is this important? Well, what you're going to notice is that short the 187, 195 call spread, stock's well above that, and then short the 200, 207.5 call spread. So what that means is that when those were initially sold, they were out of the money. Yeah, you lost money on the call spread, you made money on the stock, but then you own the gap effectively from 195 to 200. So that's, that's $5 of upside participation. $5, is that huge? Well, on a $200 stock, it's 2.5% of the stock in a week. But 2.5% incremental participation because you were short call spreads instead of just outright short calls or short that wider spread is one of the reasons why Nvidia gained 11.5% over the last 5 trading days. So long the stock, and did that do as well as Nvidia, which was up 14.9 and change when I looked at it. I was looking at it intraday. I don't know, actually. We don't need to speculate. We have a Bloomberg terminal. Why don't we just take a look? See exactly where this was a week ago. 14.84%. So for something that's paying distributions to get, we'll call it 76% of the upside. Yeah, 76.5%. 76.5% of the upside participation, as much as double digits, while you're collecting. Why don't we just take a quick peek here? What's your standstill yield on an at or just out of the money call? We'll just bump it to next week to have a. Whoops. And I'm looking at NVIDIA instead of Nvidia. So we want to take a look at these. We got the stock at 207. Look at the 210 standstill yield. 570, 560. Use the bid. Can't sell 50,000 calls. We do have to pay a little bit of a bid-ask spread. For those of you who are, trading this stuff yourself, it's one of the nice things. You can kind of pick your moments, leave some limit orders out there. We can't really do that. You don't leave a limit order out on 50,000 calls just laying on the offer, resting on the bid. So that's 2.7% a week on a standstill basis. That's to sell a strike that's $2.5 out of the money. So that means that the best case on a long stock position, if all you did was buy the stock and sell next week's covered call on the 210 strike, is that you could get $3 worth of appreciation plus another $5.60 in the stock. So that's call it $8.60 over 207, 4%. It's 4.1, 4.2% ish. So it does show the benefits of saying, okay, rather than being really greedy and trying to maximize my premium here, sometimes just selling call spreads against your long equity. That way, and you're just doing this, just steadily chiseling away. So 65% of the time, you're going to sell those options. They expire worthless or at least profitable. And in those cases where you get something really wrong and the stock rockets higher, 15% in a week, or pulls what Nokia did, or pulls what Oracle did several weeks ago, what Cat did today. Carter Worth, by the way, recommended selling strangles on this one, basically at the level from which the stock came. So let's do a 30-day chart here. His break-evens, and his was really short-dated, but just going out to Nov regular, selling this put, and selling like a 600 call, and the break points on that, because vol did come in a bit on this news, but is still bid, is really wide. Right, so effectively purchasing the stock at the pre-news price. Now you can decide for yourself whether you think this news is really impactful. For Caterpillar to saying, "Oh, we're part of the AI trade." All right, well, okay. Do I think there's some incremental business? because they have to build out data centers? Yes. Is it enough to... How many excavators, how many bulldozers are being sold incrementally because of that construction? Is it enough to move the needle for a business that's doing 62 billion plus in sales? I don't know. Here we have another comment, and this is about the things that JPow even mentioned that yes, there's issues in the auto loans, but he doesn't see weakness elsewhere in other credit areas. I'm paraphrasing, of course, but it was around those lines. Well, here's the thing I was thinking about. So I was thinking about sort of the levered loan space. Let's leave the subprime autos out for a second. It's a big market. It's got cracks, right? What are we at? Like a 6.4 delinquency rate right now, being defined as more than 60 days in arrears on your auto loan. There's a whole bunch of things about this that get ugly all at once. First of all, you're dealing with subprime borrowers at way above prime rates. So people who can ill afford can afford it even less when they're paying 300, 400 basis points over. But more troubling than that is that you have a whole basket of collateral that naturally depreciates anyway. Add to that potential pressure just on the basis of high prices, on the fact that they're paying higher rates, and the fact that these subprime borrowers are struggling. And I think that the depreciation for these assets is probably going to be much more pronounced. I was actually thinking about this. I was thinking, we got 3 cars. Should we ditch one of these things? I mean, this thing that's sitting in the driveway, is this going to, is it going to drop $10,000 over the course of the next 6 months? A car that I drive 5,000-6,000 miles a year, am I better off taking an Uber? I mean, that plus seeing the renewals on my California registration, because one of these cars has to get a renewal, and thinking, really, is that how much it costs to re-register a car? My point is that I think the auto loan thing is an issue, but the levered loan thing, which hasn't really been discussed much, what's in that universe? We are talking about, not the big capital markets access businesses. What are we talking about? $25, $50 million businesses. And, those portfolios have been paying high single digits, very low double digits. It's pretty high rates of return. And that means that you're dealing with a fairly distressed borrower class, much like you are on the subprime loans. And if you start to see some weakness in the underpinning businesses, and not everything is following the same track as the AI trade, right? Some other businesses are struggling. I'm monitoring that pretty closely. And by the way, is the chairman of the Federal Reserve going to come out and say, I'm really worried about this? Guys, we're talking about it behind the scenes, and there's a lot you don't know. Is that the kind of guy JPow is? No, I mean, they jawbone the economy as well. They talk things, that's the power of Fed speak, right? Part of it is policy. Part of it is narrative. Control the narrative and see whether you can't make sure that you massage things the way you want to go. I am more worried about that space, I think, just because it's an unnatural level that people are paying, and in many cases, some of these other industries aren't really crushing it. And that's just a tough recipe, right? We know it's been tough on some retailers. We've seen some other areas of weakness in the consumer space. But I don't know what the real answer to this is. But I'm saying I am cognizant that, oftentimes, you don't know how bad it is until a little bit later. I would just offer that. Yeah. I'm being pointed out. I missed a question. Yeah. So I used to, but what is YieldMax plans for FIAT? So I mentioned this on one of the other open mic live streams, and I did talk to the title compliance department about this. There are some limits. I can't really talk about what we're planning to do. I guess that's the simple thing. If there's going to be a change in an outstanding security, we'll put out a filing, and then we can discuss what's in that filing. But I can't discuss something that we may do or may be planning to do if we haven't already made a public disclosure about that. So I apologize for that. But that's, yeah, sometimes it's the unhappy circumstance that we can't speak freely on every single topic, and this just happens to run into. So, I can go into what's going on in NVIDIA, and I can show you the positions that we have, because those are publicly disclosed. Like that's actually going to get updated. Those get updated every night. So you don't have to have a Bloomberg terminal even to find out what those things are. You can just log onto the website, download the positions, see how they changed it today, whatever you like. But if when it comes to questions about what we may do or may be planning to do where we haven't actually filed, so that's the first thing. And the second thing is that when we do make a public disclosure, it has to be in a public forum. So that means, issue a press release. And I'm pretty certain that making an announcement on my own private YouTube channel would not count as, the firm's official announcement. So I apologize for that. But, on the other stuff, I'm happy to try to help out and discuss when, if, and how I can. So on that, I guess, somewhat unhappy note that I can't answer every question every time that I might like to, I've used up an hour. So for those of you who have stuck around for all of this, I really appreciate your time and attention. Oh, what's that? Capital Fund. Oh, so we just got a question here. Let's try to touch this. You know what? Maybe I should do this because I know that some people, I don't know how much of a lag there is in these questions. So I'll say that we're gonna talk about BA and then we'll go. That way, if you're thinking about writing a question, put it into the comment section, not the chat. That way we can address it in a future video. So that's a good opportunity for anybody who is not subscribed, hasn't hit the like button, and never left us a comment for a future video. Do that now. But let's take a look at Boeing here now. Okay, oops. Well, first of all, let's take a look at the list of catalysts that we've got upcoming in Boeing. So 747 loss was the number that we got. Is that? And that's a lot worse than expected. What was the rest of it? I'm just going to go. I have to put in quarterlies because we're looking at the most recent result set. Yeah, you know what? That's a good point. Good point. Look here. It's 7. This one got rounded to 746. But on the SERP sheet, let me see. Oops. Let's take a look. Was it 7? So I just saw 747 in that. Yeah, okay, so it depends which way you round it. So the actual reported number is a loss of $7.46.5 a share, which got rounded to 747 by Bloomberg, and then on this thing it got rounded down. I think 747 is arguably their most famous airplane. I don't know, maybe the 727 was, not 707 was their most famous airplane back in the day, but I kind of think of the 747 as the iconic Boeing airplane. So we'll call it a loss of $7.47 a share. Top line growth, though, not so bad. And, we've got a little bit of a setback in the price. Let's take a look at the thing technically here. Crack the 50. That's pretty weak relative performance since late July. This takes us down to, what did I just say the stock was right now? 200? 230. Okay. Oh, it's basically still right about where it was on the close. And let's see whether Vol kept a bid throughout the day, because that was a pre-announcement. So let's see here. We got pre-market I'm talking about. So technically we're pretty mixed bag. Valuation. Much cheaper than usual on an EV/EBITDA basis. We can't look at it on a price to earnings basis because there aren't any. What's their free cash flow? This is the only thing I get a little bit uncomfortable with. This company, they got a pretty good cash position. Yeah, that's not much of a concern there. Obviously, a lot of net debt, but and what I'm interested in here is, so their net debt is one issue, but also how much cash do they actually have, because that does make a difference. So if you could have the same amount of net debt, but if you got $4 billion in cash on the balance sheet and a forecast future negative free cash flow of $4 billion, that means you have to raise. Not true here. So, yeah, I don't know that this is the time to go racing into it. I don't know that today's dip, 5%, 6%, whatever that was, I don't know that that's enough to go racing in. It just feels heavy, doesn't it? Better places to have your money, I think. That's my short version. But I don't mind if you own it. And this is another perfect example. I mean, the stock's trading $200. You could easily have picked it up at 140 earlier this year. And if you were one of those people, do you sell some covered calls against it? Now that the news is out, let's take a look at what the implied vol is. That's not that high either. See what the 1 year mean is, 34, and it's 32 for 1 month implied. How about two? Oops, that's not what I meant to do. I'm gonna make it 2 years. It doesn't matter. 2 month implied's at 31 and change versus 33. Like I said, there's a little leverage on the balance sheet, so adjust for that, right? So how do I do that? I take a look at the difference between the enterprise value and the market cap. So we've got 162 divided by 198.5. It's 81% of 32 vol. Do I like 26 vol against the enterprise value of the business? Because that's really what you're selling. Yeah, not really. I guess I kind of have a no touch on this one. Not terribly excited about it. I mean, take a look at next year's numbers. $3 a share. It's not like, yeah, I mean, I think the story is strong enough that we don't have to worry about. I think they're not going to run into liquidity problems in the near term. But I also don't think the stock's going to take off in the near term either. Pardon the pun. Company that manufactures jets taking off. But yeah, I think this one's going to be grounded for a little while. The story is stronger than the debt. I think it can overcome that, but yeah, it's hard for me to get excited. We start to see this thing show some relative strength, which it most certainly hasn't. I mean, it's been weak relative to the market for probably 75 trading days now, 75 calendar days now, and this was another setback, which arguably people could have anticipated this. That would help explain the price action. But why do we want to race into it? Because it's screamingly cheap? It's not. My 2 cents for what it's worth. All right, everybody. I really appreciate you all tuning in, giving me a listen. And like I said, like, subscribe, all that kind of good stuff. And come on back. We'll be here next Monday, 4:15 Eastern Time. Thanks for watching.